Origo News.
VYM versus FDVV, comparing dividend, ETFs on yield, costs, and risk. The Vanguard High Dividend Yield, ETF VYM, and the Fidelity High Dividend, FDVV both target U.S. companies with strong dividend payouts, yet they differ substantially in their investment strategies. VYM follows a broad, rule-based approach to select high-dividend stocks, while FDVV employs a more sector-focused strategy, concentrating on specific industries. These differing strategies lead to distinctions in costs, portfolio structure, and risk exposure. Here's a detailed comparison between the two funds. Cost and size comparison. Beta measures the volatility of an asset relative to the broader market, with a higher beta signifying greater risk. The one-year return indicates the total return over the past 12 months, while the dividend yield reflects the annual dividend payments relative to the current price of the fund. Performance and risk comparison. Portfolio composition. VYM tracks the FTSE High Dividend Yield Index, holding 566 stocks. Its significant exposure includes financial services 21, technology 18, and healthcare 13. Major holdings consist of companies like Broadcom, Morgan Chase, and ExxonMobil. This broad diversification aims to provide stability while mitigating risks. In contrast, FDVV focuses on a more concentrated portfolio of 107 stocks, with a heavier emphasis on the technology sector 26 and consumer defensive stocks 12. Its key holdings feature names such as Nvidia, Microsoft, and Apple. This sector-specific approach targets higher dividend yields, but comes with a higher risk due to its concentrated nature in certain industries. What does this mean for investors? VYM and FDVV have shown similar total returns over the past year and 5 years. However, their differences in fees, dividend yields, and risk exposure set them apart. FDVV offers a higher dividend yield of 3.2 compared to VYM's 2.42. For investors seeking higher dividend income, FDVV may be the better choice. However, FDVV also has a higher expense ratio, 0.15 versus 0.6, meaning some of the extra dividend income will be offset by fees. After factoring in these costs, the net dividend income from both funds will likely be quite similar. In terms of risk, fee heavier concentration in the technology sector, an area known for higher volatility results in a higher beta and a larger drawdown over the past 5 years. While technology stocks can yield significant returns, they tend to be more sensitive to market swings. Therefore, investors who prefer more stability might find VYM's broader, diversified approach, with a smaller exposure to tech stocks, more appealing. Ultimately, both VYM and FDVV have their own advantages and may attract different types of investors. If you prioritize low fees and a diversified portfolio with an emphasis on stability, VYM could be the better option. However, if you're seeking higher dividend income and are comfortable with the additional volatility from technology stocks, FDVV might suit your goals more effectively.
Origo News.